For most of modern history, housing had a simple purpose. It was a place to live. A home meant shelter, stability, a base for family and work. You bought a house to live in it. You paid it off over time, and eventually it became a source of security. Housing was not expected to perform, it was expected to last. Today, that idea feels outdated. Housing still looks like shelter, but it behaves like something else. It trades like an asset, it appreciates like an investment, and it's treated as a store of wealth. Homes are discussed in terms of returns, neighborhoods are evaluated like portfolios, prices are tracked like stock charts. So how did housing stop being a place to live and become a financial product? To answer that, we have to look beyond supply and demand, because this shift wasn't an accident. It happened gradually, quietly. As housing was absorbed into the financial system, the first major shift was credit. For much of the 20th century, mortgages were limited. Large down payments, short loan terms, strict lending standards. Borrowing was constrained by income and savings. This kept home prices loosely anchored to what households could realistically afford. But over time, lending expanded. Longer loan terms, lower down payments, more flexible qualification, access to credit increased dramatically. This expansion was framed as progress. More people could buy homes, home ownership rates increased, the middle class expanded, and for a while this felt like success. But easier credit came with a side effect. It increased purchasing power without increasing supply. More buyers entered the market. Each buyer could bid more. When more money competes for the same number of homes, prices rise. The constraint didn't disappear. It shifted. The second shift was interest rates. As inflation declined in the late 20th century, interest rates followed. Borrowing became cheaper. Monthly payments fell, even as home prices climbed. This created an illusion of affordability. People weren't buying cheaper homes. They were buying more expensive homes with cheaper money. As long as monthly payments felt manageable, prices seemed justified. Low rates masked higher prices, and as prices rose, existing homeowners benefited. Equity increased on paper. Borrowing against housing became easier. Housing began to look less like a cost and more like a wealth-building tool. The home was no longer just somewhere you lived. It was something that worked for you. The third shift was financialization. Mortgages stopped being simple loans between banks and households. They became products. Loans were bundled, packaged, sold. Risk was distributed across the financial system. Banks no longer needed to hold mortgages until maturity. They could originate loans, sell them, and repeat the process. This changed incentives. Lending volume mattered more than long-term outcomes. More loans meant more fees. Scale became the goal. More loans, more buyers, more demand. Housing became a pipeline for financial returns. Not just a place for families to settle, but a mechanism for capital to circulate. At the same time, policy reinforced the shift. Governments encouraged homeownership, tax incentives, subsidies, loan guarantees. Housing became both social policy and economic engine. Rising home prices were framed as success. They increased household wealth on paper. They supported consumer spending. They stabilized political systems. Homeowners felt richer. Consumption stayed strong. Few policymakers wanted prices to fall. A strong housing market became synonymous with a healthy economy. Over time, price appreciation stopped being a side effect. It became an objective. As prices rose, housing attracted investors. At first, individuals. Later, institutions, funds, corporations, asset managers. Homes entered portfolios, not as shelter, but as yield. Housing offered something rare: steady demand, legal protection, perceived safety. Compared to volatile markets, housing felt stable. Once housing became an investment, its logic changed. Vacancy wasn't failure. It was optionality. Rent wasn't about covering costs. It was about returns. Ownership wasn't about living. It was about appreciation. Housing began competing with other assets: stocks, bonds, commodities. But unlike those assets, housing is essential. People cannot opt out. Global capital noticed this. In a world of low interest rates and excess savings, money searched for places to park. Housing fit perfectly. It was tangible, scarce, protected by law. Capital flowed across borders into local housing markets, not to live, but to store value. Prices began drifting away from local wages. Homes were no longer priced for residence, They were priced for capital. This created a quiet divide. Those who entered the housing market earlier benefited from rising prices and leverage. Those who entered later faced higher prices and greater risk. Two households could earn similar incomes, work equally hard, save responsibly, and still end up in very different positions, not because of discipline, but because of timing. Housing rewards early entry. Once prices rise, entry becomes harder without assistance or leverage. This is how housing shifts from opportunity into gatekeeper. Housing supply moves slowly. Land is limited. Zoning restricts density. Construction takes time. So when demand rises, especially capital-driven demand, prices adjust faster than supply. The result is predictable. Homes become more expensive, not because they're better, but because they're financialized. As housing prices rose, building priorities shifted. Luxury units, short-term rentals, high-yield developments. Affordable housing doesn't maximize returns, so it's underbuilt. The market responds rationally to incentives, but those incentives no longer prioritize shelter. Renters feel this most directly. As prices rise, rents eventually follow. Not immediately, but persistently. Landlords face higher purchase costs. They pass those costs forward. Rent becomes disconnected from wages. For many, renting stops being temporary. It becomes permanent. And unlike owners, renters don't benefit from appreciation. They absorb the adjustment. Rising prices benefit homeowners individually, but they raise barriers for everyone else. This creates a political contradiction. People want affordability, but not falling prices. Lower prices help buyers. Higher prices protect owners. Both groups vote, so policy tends to preserve stability over access. Mortgages are long-term commitments. Banks, governments, households all rely on predictable housing values. A sharp price drop threatens balance sheets. Loans weaken, collateral shrinks, confidence erodes. So the system resists correction, prices plateau, then rise again. Housing doesn't reset easily. At this point, housing is fully embedded in finance. It's collateral, leverage, security. It supports loans, investments, and consumption. Undoing this would require changing how wealth is stored and protected. That's not a housing problem. It's a financial one. This doesn't mean anyone made a single mistake. Each step made sense in isolation. Easier credit, expanded access. Lower rates stabilized economies. Financial innovation increased efficiency. But together, they transformed housing from necessity into asset. So when housing feels out of reach, it's not just about supply shortages, it's that housing is now doing two jobs at once, sheltering people and preserving wealth. Those goals conflict. And in a system that prioritizes capital stability, wealth preservation usually wins. Housing didn't stop being a place to live, but it stopped being only that. It became a financial product. And once that happens, prices stop reflecting incomes and start reflecting capital flows. Understanding this doesn't solve the problem, but it explains why it persists and why, in many places, housing feels permanently expensive. Not because people want it to be, but because the system now depends on it.